thank you for joining us on this second quarter Guide to the Markets Asia web conference. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And joining me as always is my great colleague, Kerry Craig, who is our Senior Global Market Strategist based in Australia. Now, today is a special day for a number of reasons. Not only this is the market start of the second quarter, but obviously it is also quite an important day when it comes to the developments in the Middle East with the US and Iran war that's been ongoing for more than a month now. As hopefully everyone knows by now, both President Trump on the US side and also Iran have announced there's going to be a 2-week ceasefire to facilitate negotiation. Iran also mentioned that they'll allow for some safe passage of ships across the Strait of Hormuz, which clearly has been the choke point of this whole conflict. The global impact on both energy, but also broader commodities and materials that goes through the strait from the Gulf to the rest of the world. So to us, it's really important to really just walk through some of the macro and market implications. So what we're going to do, Kerry and I will tag team to go through some of the topics. But just quickly on the latest announcement by both the US and Iran, clearly to us, these are very positive first steps. If you look back to the last 3 or 4 weeks, we've had episodes where the US seems to be claiming victory, but Iran was not letting go, continued to attack US military facilities in the region, as well as US allies in the region. So this time around, to me, it's really the first time both the US and Iran, as well as Israel, are willing to just hold back on military actions in order to facilitate negotiation. But of course, these negotiations can still be quite fragile. Don't forget, the last 2 times Iran was negotiating with the US, that was when military action took place back in June 2025, when the US took out the nuclear facilities in Iran. And of course, more recently, late February, when again, Iran was negotiating with the US, this particular episode of attack happened. So I think Iran did say that they're entering this next phase of negotiation with a lot of skepticism. And also the fact is the demand from both Iran and the US are quite specific, and it's quite difficult to see how they will get all they want in terms of negotiation. So I think we are conservatively optimistic on today's developments, but as we've seen in the last few weeks, things can still chop and change, and not least because the reopening of the Strait of Hormuz is not like a flick of a switch. Sure, 2 weeks is going to give some ships the clarity to go through the straits and get the oil and energy products and other fertilizers, for example, to their customers. But the reality is, for empty vessels to be reloaded in the Gulf states and then get, again, moved out of the region, that's going to take days, if not a couple of weeks. So this window really will provide a bit of a relief to the global energy market. But if the Strait of Hormuz gets shut again, the disruption can still be quite significant. So I think, the overall assessment is this very much a step in the right direction, but I think the negotiation between US and Iran continues to be quite fragile, continues to be quite challenging. So, we're not quite ready to declare all clear, of course. And still, the last few weeks, we've seen investors going for liquidity as well as quality. It's really just flip-flopping between liquidity and quality. And the other side of the story is when you get positive developments, the risk-on mode comes back into play. Like this morning, you've seen the US stock futures reacted positively. You've seen Asian markets, especially Korea and Taiwan, reacted positively. You've seen a weaker dollar. You've seen bond yields coming down. So I think from that perspective, we could still be going through the seesawing in the next few weeks as negotiation continues. But for us, the longer term perspective, I think is really the key we want to discuss here. So I think we're going to divide this call into a number of parts. First of all, let's talk about what that means for asset allocation overall. And then Kerry will share with us a bit more alternatives as well as how central banks could react to this particular episode. I'll come back to talk about AI, which I think still very much capture the imagination of investors across the APAC. They will talk about dollar and gold as well. So very quickly, I think the key issue is in 2026, in March, a lot of investors are handling the Middle Eastern crisis very similar to 2022, where we have a spike in energy prices, a spike in food prices as Russia invaded Ukraine. And you can see on this chart on page 89 of the Guide to the Markets, the stock bond correlation revert to quite a significant positive. So stocks and bonds are moving in the same direction because of the fear of stagflation, where you have a pickup in energy prices leading to high inflation. But at the same time, this supply side shock, both food and energy, is going to create a drawdown or a decline in disposable income of consumers around the world. That means less spending power. The uncertainties from geopolitics also means companies may choose to pull back on investment. Therefore, you get that very undesirable combination of high inflation and lower growth. That stagflation environment, as we've highlighted at the end of last year, that is the most difficult to work on asset allocation. So what you have right now is a sort of a mini episode of that, where stock went down, bond price went down, bond yield went up. So in that sense, it's not that dissimilar. But I think it's also important to recognize that there are significant differences between 2022 and 2026. We've again addressed this question both on the minds of investors as well as our monthly market recap that came out in the last couple of weeks. But just briefly here, first of all, 2022 was really a year where all the inflation risk joined together into a perfect storm of inflation. Not only energy prices went up significantly and food prices went up significantly, you also had the recovery from COVID, and therefore a lot of pent-up demand was released at the same time. So the first point. The second point was central bank policies were incredibly loose at the time, and what that means was when inflation started to accelerate, central banks have to go from an incredibly loose monetary policy into a neutral, if not slightly tight, monetary policy, and that really hurt the bond market, both in the government bond markets around the world, but also in corporate bond markets because of that duration risk. I think in 2026, growth is okay, but we're not coming from a recession into recovery. That growth momentum, the inflation pressure from the demand side is much more modest. More importantly, central banks are running their monetary policy very close to neutral, if not slightly above neutral for some cases. And therefore, even as we discuss the risk of central bank rate increases, the magnitude is very small, or will be a lot smaller compared to 2022 and 2023. And therefore, the impact on bond markets is likely to be less significant. But again, we'll dive into that in just a moment. But Kerry, I think one of the outperformers in 2022 was alternatives, whether it's in infrastructure or real estate, or in, for example, private equity or private credits. Where are we this time with alternative assets?
Thanks, Ty. Good afternoon, everyone. Thank you for joining us today. I mean, absolutely right, Ty. We're thinking about the ability to diversify portfolios against some of these risks. And importantly, the risk that you can't see coming is where that diversification benefit really plays out. It has reinforced the sort of view around why alternatives do have a very strong role in that portfolio to actually mitigate some of these concerns, given we did have that increase in that stock bond correlation come up in the short term, given that it's that inflation that's driving it rather than growth, pushing those yields higher. And your earlier point around, I guess, the duration of this conflict being something that's seen as an inflation shock rather than migrating into a growth shock is also important to consider in terms of the sequencing of what that means. Now, for us, we have talked, at length about the need to have alternatives in a portfolio. That shift from being something that was seen as optional to something that's become much more essential, and largely it is because of those benefits around that diversification. The chart on the screen, very familiar. I've had in the Guide to the Markets and the Guide to Alternatives for some time. Just shows you the correlation of those asset classes in the alternative landscape. With a stock bond portfolio, the bubble size is the yield or income generated from that asset and then the vertical is the annualized return over the last decade, looking back at what they did. So basically anything to the left side of the chart is something that will provide that diversification against both stocks and bonds in a portfolio. Typically, they're going to lump themselves into the real asset classes. So there you have those blue bubbles of transport, you've got real estate, you've got timberland and infrastructure, physical things that you can actually see and buy and invest in that are less sensitive to the economy. There are essential services. They are required for the operation of the economy around the world. They typically have somewhat of a longer duration in terms of thinking around their role, and so they can offer more income on the back of that. And they are the things that you do look towards adding to your portfolio to both create that resilience in terms of some of these shocks, that diversification, but also generate that income. That's been the one of the bigger drivers when we had the very low rates from fixed income, was looking toward these income generating assets that were also defensively viewed in a portfolio. Now, I would also stress when we look at these asset classes, obviously when we think about the role of real assets and how they fit, they can be across the spectrum from something that is seen as being opportunistic to something that's more sort of core in nature. And we would argue that it's kind of the core end we'd want to start. So by core, we mean things that have a low volatility in terms of what they're doing. They're usually associated with lending to very high quality counterparts and have those steady cash flows, particularly in the areas of like infrastructure, energy, and electricity production. It's regulated utilities where there's contracts in place. And also because of that, because they're regulated, they have those contracts. Usually there's a component of that that is linked back to inflation. And so again, these asset classes provide somewhat of an inflation hedge. Or take timberland, again, it's inflationary hedging characteristics because, again, it's used to link back to the development of housing, which is the main use of timber around the world. So you're getting the positive benefit from these asset classes from both thinking about the uplift from that diversification, the income that we're going to get from that, as well as thinking about that inflation protection overall. Now, it may seem odd to be talking about transport a little bit, given what we've seen with shipping around the Strait of Hormuz, but just to demonstrate that it's not always around whether the ships are moving. It's about the leasing agreements that are in place, and those really haven't changed. In fact, we're just seeing some of those shipping routes change, which means those leases get a little bit longer. And in fact, there's probably a little bit more demand for ships as they have to travel further across new shipping routes and avoid some of these choke points that we've seen overall. And again, if we look back before the conflict, Ty, obviously one of the biggest stories out there, and the one that's still somewhat worth watching, has been around some of the concerns around the private credit space. We've seen obviously big movements in the valuations on listed BDCs or business development companies that were associated with lending in the software space, the business model disruption from AI that was also a theme earlier in the year, and how that's continuing to play through. But again, if we look at what's happening in the private credit space, that lending by business development companies that's getting all the headlines is a very, very small share of total lending that happens in the economy. You're looking at something that's around about $2 trillion in total. And that's much, much smaller if we compare it to, say, the market cap of the Barclays Agg, which is about 75 trillion. So it's getting a lot of headlines, but it's worth remembering that's a relatively small share of lending that's happening in the economy. Obviously, there's going to be probably more to come in terms of discovery on some of the implications of the prices coming through. But given the movement you've seen down in those valuations on the BDC companies, and simply thinking about the movements in the past when valuations have got that low, I think there'll be also those investors who are looking for an opportunity on an asset class that's been relatively heavily sold off, where some of the risks may not be as present, or at least some of the risks are not likely present in all types of funds. We think about dispersion and manager performance across the alternative space. And so again, even in private equity, private credit, we could see some opportunities coming back. But for the diversification benefit, for the income benefit, for the diversification across your portfolio, it's definitely the left-hand side of this chart that we're focusing on more on in terms of thinking about building more robust portfolios. Again, what we saw back in 2022, seeing it mirrored today to a certain extent, again, reinforcing that role for having them in a portfolio.
Brilliant. Thanks, Gary. I think in terms of our asset allocation view, as I mentioned earlier, very tactically in the short term, because of the uncertainties of the situation in the Middle East, many investors may still opt for liquidity as well as for quality. These are typically the time for a bit more dial down on the risk appetites. But it does not mean investors should just hold cash. And we've had a lot of materials and lots of research to show that geopolitical events only have short-term impacts on markets. In the longer run, being 1 year or even 3 years, typically a well-diversified asset allocation or portfolio can outperform cash. And as Kerry rightly pointed out, if you add alternative assets, whether it's in infrastructure or transportation, that are income generating, or when it comes to private equity or private credit, which is also income generating, but also have the ability to have capital gain over the long term, I think these are continue to be important building blocks for a portfolio. But Kerry, when we talk about fixed income, I think one of the key questions we've been asked a lot in the last few weeks is that the higher energy cost, is that going to mess up central banks' policy path? We've seen central banks cutting rates for the last couple of years. The Fed was expected to cut rates maybe middle of this year or later this year, but obviously what's happening right now with energy prices has disrupted that view. Now, Reserve Bank of Australia have hike rates recently. Maybe we can start with the RBA, but more importantly, what's your take on developed market central banks when it comes to the prospects of going from rate cut cycle to a rate hike cycle?
I mean, yeah, it's an excellent question, Ty. I think that what we've seen, obviously, coming into the year was more around the divergence within central banks. 2025 was a story of policy easing across the board. And then this year we knew that a lot of central banks on the major side, so ECB, the Bank of England, the Federal Reserve, did come to either the end of that policy because they had that inflation back roughly where they wanted it. They were kind of a neutral or very close to it. There was prospects for further rate cuts to support growth in the US context, or thinking about the need to not cut rates further because you had inflation at an adverse level within the European Union. And then the UK being a slightly different beast, given some of the disruption that's happened there and the stickiness on the services inflation. So now the outlook again is for that divergent view within central banks. It does seem to be that based either on the central bank mandate and how they're focused. So again, if it's the Federal Reserve, it's about thinking around both the growth aspects of the shock that's coming through the labor market and maintaining that mandate about full employment, as well as price stability. For other markets, whether it's the ECB or the Reserve Bank of Australia, it's more around keeping inflation in that target band or at that target level. And so this is going to dictate how we think about central bank policy from here. I would stress that just thinking about the inflationary consequences as well, we have to consider the pass-through from the shock into the rest of the economy. This chart is not something that we look at that often in the guide, but I think it's a great one because it gives you that historical context around those very deep red figures there that shows you that inflation impact back during 2022 when you came out of either the Ukrainian conflict, the sharp movement in oil prices, and kind of how that was felt across the board. It's slightly varying times for many of these economies around the world. This time it is a little bit different, as you mentioned, Ty, given where we are starting with policy rates in many countries, but also where we're starting with inflation. So you can see that across parts of the emerging Asia point of view, we actually have very low rates of inflation or even challenges with what has been disinflation in the process of China, or even looking at what's happening in Malaysia or Thailand. And so there's a little bit of a difference in thinking about that inflationary outcome from this, and also the pass-through effect. So again, if we compare, say, what we're seeing in the Eurozone with the Fed, with the US in the Eurozone, typically we've seen that inflation pass-through from headline to core being quite strong and a central bank that reacts to that. Whereas in the case of the US, that pass-through from headline inflation driven by high energy costs doesn't always filter through to the underlying levels of inflation in terms of core, which is what central banks focus on, because they're thinking more around an economy that's much more services orientated. And so therefore it's more about the wages that actually drive that, and that assumption around that wage cycle in terms of work is going to start demanding higher wages because of that. So there's a few different dynamics in play here, which I think will impact how central banks are going to react. And the next one I would point out would be, again, the government response. So we've seen some response across the parts of the Asian markets around governments trying to mitigate the impact on consumers, whether it's processes to either cap fuel prices. In Australia, they're reducing the excise tax on fuel to try and lower that price. Now, the more the governments step in to try and mitigate that impact on consumers, it does mean that consumers have more money to spend elsewhere in the economy, that doesn't mean they lean back against those higher prices, and that can actually be a bit more of a negative. So in 2022, obviously, we've had a very strong response from governments in terms of providing that fiscal support. Probably not going to see that this time around. And so that does have, again, consequences for thinking about how central banks will react to that and whether they'll need to. I think it's also, again, the difference on the labour market. While we do look at unemployment rates that are typically very low across developed markets, you would hard to argue that labour markets are strong. They just have a very high level of tightness about them, but unemployment rates are expected to rise. So we wouldn't see that same level of worker degree in terms of demanding higher wages starting to come through from the shock, especially if it proves to be more temporary this time around. And so central banks may have to worry less about that unanchoring of those inflation expectations, which they're so focused on. So when it comes to how central banks are likely to react to the shock relative to what we're seeing priced by the market, you've seen some very aggressive pricing in terms of either looking at, say, the light blue line there, which is the Eurozone, in terms of the market looking for a 3 rate hike, so pushing the policy rate up from 2 to 2.75% over the sort of end of next year. You know, that's probably more than we would expect to do. I think the messaging from the European Central Bank has been hawkish. Obviously, they're trying to talk down those inflation expectations. They're obviously focused on that inflationary impulse and whether they'll need to act. But, you know, maybe they do go one more, but I don't think they'll go 3 more, given that there is going to be a growth consequence coming through from those energy implications we have seen in terms of what it means for the European Union. And it's a similar case when we look at, say, the UK there. We think that also the Bank of England is more likely to be on hold in this environment as they wait and see what the inflation and growth consequences are of this rather than moving for hikes. The only outlier would be the Bank of Japan, where we continue to think about that policy normalization coming through there, if anything else, and again, not too worried about or looking through some of the supply shock they've seen overall. So I think central banks are probably still going to be relatively patient. We could see, you know, potentially across developed markets, the RBA do another one, potentially ECB, but I think they're going to be quite patient in waiting to see what the actual inflationary and growth consequences of this shock are. Because while today's news is very positive, as you mentioned, Ty, this is just the beginning of what these negotiations could look like, the resumption of that free flow of energy out of the Middle East, as well as other inputs to the production process, and also thinking about where the energy prices actually do settle after this, given there will be a risk premium in them. So I think it's going to be still quite a divergent view. And finally, when it comes to the central banks, I think the biggest view around this is on the Fed. The thing that really strikes me about this chart is that that grey line for the Fed has continued to come down. The market's still thinking about those price cuts coming through in the Fed regard. I think again the Fed is going to be pretty patient. I think that there may be one cut this year should growth slow in the fourth quarter. We're going to get obviously the benefit of that fiscal stimulus still coming through in the middle of the year with those tax rebates. Our boss David Kelly is also talking about the prospects for, you know, maybe some sort of tariff check in the post to households ahead of the midterms to perhaps carry favour for the government. But all that could add a little bit more of a fiscal stimulus in the middle of the year that would eventually fade through the second part of the year. And again, that pass-through effect is not so strong on underlying inflation. And so you might see that growth actually continue to come down and inflation not nearly be as persistent as it was back in, you know, the 2022 era, and again, allowing the Fed to cut rates there. So I think it's going to be a very divergent view when it comes to the outlook for central banks. That does mean that for fixed income investors, there's obviously opportunities across the fixed income landscape when it comes to government bonds and positioning. We've seen yields that moved up to about 4.3% roughly in the US, so still roughly within what we thought would be an ample range of between 4 and 4.5, not aggressively. We saw a move over 5 here in Australia, but have come down quite a long way. If we don't expect too much movement on rates, I think you're still getting, you know, a fairly good income when it comes to government bonds. I don't know how far along that duration curve you want to push out to just yet, but I think as we move towards something where we're not thinking about too much more inflation, or those inflation expectations start to ease back a little bit, that fixed income may start to look a little bit more appealing as we take away some of those big headwinds from the prospects of higher rates and higher inflation and generating income for a portfolio.
Brilliant. Thank you, Kerry. I think the key here is about not just thinking of one scenarios, but thinking about various scenarios and how that could potentially impact on the shape of the curve, as Kerry mentioned, but also the timing, the opportunity that one can generate from the curve. For example, if the energy prices stay elevated for an extended period of time, maybe central banks will be forced to raise rates a little bit more. But at the same time, as Kerry rightly pointed out, the lack of a fiscal response or the lack of room for fiscal response means that growth is likely to suffer, and that is going to create a much flatter curve or even an inverted curve if investors think that the high energy prices could lead to much weaker growth in the medium term. So that's not our core scenario, but it's important to recognize that when we think about our portfolio construction, how different scenarios could impact on the shape of the curve, the level of bond yields, as well as the credit spreads across both investment grade as well as high yield. Let's just change topics a little bit when it comes to AI. I know we may not have spoken so much about this in the last month because of the distractions in Iran, but the reality is that AI continues to be a key part of the investment universe, influence not just growth in the US, but also export performance in APAC and also earnings outlook for a lot of companies around the world. If you look at our Guide to the Markets, page 51 on the screen right now, on the right-hand side, what you see is that the level of competence of AI models and also the costs of processing continues to improve over time. So from the launch of ChatGPT back in 2023 to where we are now, the world of AI has developed significantly. And many of these hyperscalers, they're starting to find their own directions on what they should be doing with their models. I think to start off with, they want a all singing or dancing model for consumers and businesses and to do all kinds of functions. But right now, as the cost of compute continues to rise, because in the case of the US, the lack of power, lack of electricity meant that that's a constraint. In the case of China, the lack of GPU, that's a constraint. I think therefore, many of these hyperscalers are forced to economize or find ways to make their capex to stretch further, and therefore we're starting to see more specialization by different hyperscalers or model developers. I think that's one of the key thesis for us at the end of last year in our 2026 outlook, and that is investors will spend more time differentiating not only the winners and losers of these hyperscalers, but what each of these hyperscalers could turn into, whether it's more consumer-facing subscription-based model or more a corporate solution when it comes to how these AIs and these models are going to be used. At the same time, something that we've been highlighting for quite some time now, on the right-hand side, adoption rate is on the rise. In the US, in China, in APAC. Kerry was telling you just now that Australia per capita is one of the most intense user of artificial intelligence. Now, of course, some people like me maybe just making cat dancing videos, but some are actually making programs for their business or just to make their lives easier. So I think from that perspective, AI is being integrated into both our personal and our business lives. But the question is, are these hyperscalers going to be quick enough in monetizing these services to justify their capex? I think there is still a little bit of a gap, but over time, I do expect it to change. The other aspect, again, a theme that we've been very much highlighting for the last 6 to 9 months is on the left-hand chart of page 52, is the different points of adoption of AI. So if you are financial companies like us or information IT companies that are into services or in real estate or in healthcare, you're more likely to be using AI today because a lot of the hardware investment is already done. I've got a desktop and the company set up its own LLM. I don't need extra hardware as of now in order for us to make use of LLM in order to make our life more productive. But if you look at the left-hand side, the bottom half of that page, manufacturing, retail sales or retail trade, construction, logistics, F&B, these sectors, they need additional hardware, more capex, not just on models, but also on hardware. For example, how to fit autonomous driving into your fleet of trucks, how to install new robots in factories in order to take on more complicated, more manual jobs. So I think all of that allows for two things. One is the hardware developments in robotics and autonomous driving as examples of how, to further push the use of AI models. The second thing is, especially in the case of China, their AI development is more geared towards manufacturing instead of inference, for example, how to write things or how to make videos. I think that, again, creates more branches of opportunities when it comes to AI. But if I come back to the US technology for just for 1 minute, I think a couple of interesting aspects. First of all, if you look at the bottom right-hand chart of page 53 of the guide, this is a new chart where we mapped out Max 7 in S&P 500, the remaining part of the S&P 500, the blue bar, and then the over S&P 500, the gray bar. What you see, not surprisingly, 23, 24, even 25, Max 7 was really the star players. But up to about fourth quarter of last year, and then when you see 2026 year to date, Max 7 performance start to be in line, if not slightly lag behind the benchmark. And I think that's where investors are asking rational questions about CapEx, about how companies are making use of AI in order to, or making use of AI to monetize their works and their business. And I think when investors are not particularly satisfied with those answers at this point, that's why we've seen Max 7 underperform. Now, if you look at the left-hand side in terms of valuations, the green line of Max 7 price to earnings ratio, where we are today, a combination of those rational questions as well as the global markets, all of that is creating some valuation derating in Max 7 companies. And now we're largely, well, we're the cheapest we've seen since the Russian-Ukraine crisis. Now, of course, some pessimists will argue, well, if their earnings growth is going to be disappointing, or maybe their CapEx is eating too much into their cash flow earnings, arguably, this price to earning may still be a little bit too optimistic. But our view is that a lot of these Max 7 companies, they started off being very profitable, high margin companies. Yes, they've invested heavily into AI CapEx, but at least from an earnings perspective, they're still delivering from the day-to-day BAU towards their shareholders. The second point is some of these companies are already expanding on a subscription base and they're generating revenue that partially justify the CapEx they're spending in right now. So I think, again, this still requires significant amounts of active management on picking the right companies. But I do think that both US technology and US markets, more broadly, the valuation derating that we've seen in the past few months start to offer interesting entry opportunities for investors who are building the portfolio for the long term. I think in the last 1 or 2 years, one of the most frequent complaints we've had is, well, US stock looks very expensive, especially technology. So I don't want to get it. Well, now you have a slightly more attractive entry point. Is it the right time to get in? Of course, you don't have to throw all your cash in one basket, but we do think that for those investors who are long cash or who do have liquidity to deploy, this is definitely one area that we should be thinking about over the coming weeks and months, especially if the US-Iran negotiation is moving in the right direction. Okay, now I think a couple of other aspects we want to discuss briefly before we come to Q&A. One of which is the dollar. So last year, we've seen the US dollar depreciated on the back of a number of issues, questions over US exceptionalism. I think a lot of international investors, they want to diversify their portfolio. They're heavily invested in the US. They feel like they need to be more globally diversified, which means some outflow of US dollar assets. But if you look at the last 1 month, whenever there is a geopolitical tension or conflict, that flight to liquidity and quality, historically, that actually benefited the dollar. The question is, as we get into this negotiation phase, fingers crossed, we do move in the right direction. Kerry, where do you think the dollar is going to be, and how should investors think about their FX exposure?
I mean, that's a great question, Ty. It comes back to what you were just talking about. That everyone was worried about those valuations. They were concerned the market in the US was looking a bit toppy, that tech had been just basically run too far. There were concerns around the capex investment relative to the revenues. Was there going to be an ample return on equity or return on investment from all that capex? And so you have seen that underperformance. If you look at that chart there of the Magnificent Seven, that underperformance you just showed. But again, against that valuation comes down, I think there's still hues of that US exceptionalism story there. So while we typically have seen the US dollar fulfill that safe haven role and rise as that risk has been tempered in the market and sentiment has soured, and then today we've seen the US dollar come off. We've seen the AED rally. The risk on currencies typically do very well. I think there might be still some support for the US dollar in the near term, as people who are adding back to risk assets do look at the US and think, those valuations that I was concerned about a few months ago aren't really the concern I have anymore. And if those earnings stack up as they do, and they have been rising surprisingly this year, then there is an opportunity there. So that could create a little bit more of very near-term support for the US dollar. I think, though, longer term, as you mentioned, many investors have just been very heavily overweight the US for a number of years. That rotation towards Europe, that rotation towards Japan, emerging markets that we saw play through late last year and into early next year could come back to a degree as we see some of these concerns around the energy shock around the world start to mitigate itself. And again, the structural changes we've seen that always dollar negative are still very much there. So think about some of the concerns around central bank independence, whether it was the fiscal side of things, the political environment, all sort of wanting investors to maybe hedge off some of that US dollar exposure, even if they didn't want to bring down their exposure to US assets, would typically be US dollar negative for the long run. So I don't believe our long run view of the US dollar in terms of seeing that depreciation continue has changed, Ty. I think what has changed is the magnitude of that depreciation. And again, this what could be still some supportive narrative in the near term, given the uncertainty that could come with these negotiations, the fact that these can change very quickly. You may see that safe haven status come back through, or whether it's simply that allocation towards risk in the market, seeing people allocating a little bit more towards the US overall. And then finally, as we talked about before, I think the rates outlook is obviously quite key to that. The hawkishness of other central banks outside the US relative to what could be, what starts out as a hawkish central bank and the Federal Reserve becoming more dovish over the course of this year is likely to really contrast that narrative around wanting to control inflation expectations in the rest of the world. And again, places like Europe, the UK, Australia, wanting to keep the market at bay and probably sort of leaning towards a bias of still maintaining or hiking rates. And that should keep, again, a little bit more downward pressure on the dollar over the course of this year. So it should still be a case of long run structurally, the view hasn't changed around that dollar depreciation. The short term outlook is probably going to be a little bit more nimble in terms of those moving parts. But again, I think it is a case of how we see that longer term structural force coming back into play after we've seen that safe haven status start to fade off again.
Brilliant. So I'm going to wrap up with a question that I've not been asked for the last 1 month, which is the outlook on gold. That was one of the most frequently asked questions for 2025 and maybe the first couple of months of 2026. But as soon as the war started, all of a sudden, no one asked about gold anymore. Now, as we all know by now, gold did make a bit of a correction from almost $5,500 all the way down to $4,500. I think, a lot of investors were surprised. People thought that with geopolitical tension, with conflict in the Middle East, you should expect to see gold moving higher. Now, I think a couple of potential explanations. One is that, we've seen bond yields moving higher on the back of worries over inflation. That may have created some downside on gold. The other one is, if people were using gold as a hedge against war, when war actually breaks out, do you actually need gold? Or rather, do you need liquidity? And one thing that you want to maybe to sell at a time of need for liquidity is one asset that you can make tons of money on, and gold is one of them. So I think in many ways, it has proved yet again that gold's consistency as a hedge asset is not great, whether it's to hedge against geopolitical situations or conflicts, or to hedge against volatilities in risk assets such as equities, which is a point we've been making for much of the last 2 or 3 years. The fundamental investment case for gold remains. As Kerry mentioned, if we are still bearish on the dollar in the longer run, you would think that many of the central banks want to continue to diversify their reserve base away from the dollar into other assets. I think gold continues to be a very popular asset from that perspective. The second point is, of course, consumers in China, in India, in emerging markets, the demand for gold for jewelry continues. So again, I think a lot of the fundamental support for gold continues, but in the recent weeks, really the technical aspects of gold being swapped for liquidity, as well as a rising interest rate environment, has put some selling pressure from that perspective. So in the near term, maybe we'll still see gold under pressure. But in the longer run, again, a bit like the US equities, this may not be a bad time to add back some gold in your portfolio if you want to have gold in your portfolio. But again, why you want to have gold in your portfolio, the reason for that, I think you have to be super clear. We've argued for a long time that it's not great hedge assets against risk assets. Correction, it may not be great either for geopolitical events, but it's a good asset where you do get solid fundamental demand from central banks and emerging market consumers, and that to us will continue to support gold. Of course, the so-called debasement trade. Gold is a scarce asset or scarce commodity. That again is a pretty good asset to have when you've got money supply growing at rapid rates, or government bonds or government borrowing at very heavy or very strong pace. We've got a huge expansion of government debt. All of that continues to benefit gold in the longer run. So yes, I think it's still a worthy asset to be in the portfolio, but again, we've just got to be super clear when it comes to not having the not using it as a hedge asset. Thank you as always for joining us, and of course, more importantly, thank you all for joining us this afternoon. Hope you find this useful. I think just to really quickly summarize, clearly there's still a lot of uncertainties coming out of the Middle East, but again, today's arguably a good step in the right direction. Hopefully that will continue. But I think in the longer run, I think this particular crisis, while obviously it's extremely sad and tragic, it does create invest opportunities when it comes to asset allocation. So both in terms of valuation re-rating or de-rating we've seen in equities, as Kerry mentioned earlier on, in fixed income, I think we are in a position where we can allocate more of that cash position into both equities and fixed income. But of course, there could be longer term investment implications after the conflict is settled, whether it's in energy transition, whether it's in defense sector, whether it's in how countries or markets are sourcing their energy going forward. I think all of that is going to create changes that will impact on our investment. So as always, thank you. We do have our weekly On the Market with Investors, which are tracking these events very closely. And of course, our podcasts. Many charts you see today in the presentation, they are also available in a daily guide to the markets. That's on the website. And we'll see you next time on our web conference to discuss whether it's the Federal Reserve, the situation in the Middle East, or our next quarter's guide to the markets. Thank you.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from J.P. Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.